Hey everyone, thanks for joining us for our weekly Laundry and Learn. I'm Annie Dickerson, and with me is Julie Lamb, and we've got a lot of laundry to fold. And we're going to be folding our laundry and talking about real estate. But first, Julie, I wanted to share this quote with you that I saw the other day. I thought it was so perfect for this. Sometimes I wish I could be the load of laundry in my dryer, so I could sit in a dark, quiet space and everyone would ignore me for at least a week.
I love that. Oh my goodness. Yeah.
So
I definitely
true. How many times have you like put a load in and you're like, I have every intention of folding it tonight, and then it sits in there. It's like, what?
That's right. That's right. In fact, last week after we started folding and then we didn't finish on the on the Facebook Live, and I ended up, those clothes sat there until later that evening. They sat there all day until I could finish it later that evening. So I love yeah.
Ours did too.
That's funny.
Well, I know that you've got not a lot of battery on your computer, so I wanted to get right into it today. One of the questions that investors ask me all the time, and I'm sure they ask you all the time too, is, the recession. When is this recession coming? And, how are we sort of protecting our assets and hedging against a potential downturn? So what do you have to say about that?
Yeah, I mean, it really starts, I feel like, from the top in terms of, what asset class are we even investing in? And that's, really for me, the funny thing is back in 2016, I thought that we were already at the top in 2016. Right. In fact, I thought we were at the top in 2015 because I don't know if you remember, or if Joe was in real estate already at that time, but 2015 in the Bay Area, it was, bananas here. I mean, stuff was like flying off the shelves. People were, overpaying. It was crazy back then even. And I thought, oh my gosh, I got to get out of my Oakland property. I got to get out of this now, And so that's when we started thinking about getting out of it. And so then in 2016, it finally sold. And as I was starting to think about, what the next move would be in terms of investing in real estate, I thought, like I said, at the time that we were at the top. And so, I had looked into all kinds of different, investment opportunities like flipping and development and hard money lending and, all kinds of different things. And, at the end of the day, the conclusion that I came to was that multifamily would be the asset class that I needed to get into for a number of reasons. But I think primarily the number one reason that it was interesting to me was because I thought that if I could rent, if I bought a single family home, right, and we hit a recession, tenant couldn't pay the rent, and, either I had to evict or they had to, they just decided to leave and go somewhere cheaper, my income would go from, 100% income to 0% income overnight, right? And so I thought that if I invested in multifamily, large multifamily buildings, that even if I lost, in a 300 unit apartment building, even if we lost, a handful of tenants, we would still potentially be at like a 90% occupancy, right? And so how likely be that many people would move out overnight. So that's where I usually start the conversation when I'm talking with investors, is the decision to even focus on multifamily for us in and of itself is like a hedge potentially against any kind of, correction or recession in terms of occupancy. I mean, when you talk about, rentals, the whole thing comes down to occupancy, right? So when you have a rental property, the whole name of the game is to keep the property occupied and keep your tenants happy and keep the money coming in. And so just even focusing on multifamily for us, I think is, that's why multifamily, among other reasons, but I would say that was kind of like the primary reason why we even, looked at multifamily and have that as our core, investment asset class, along with, the other two, mobile home parks and self-storage. So that's really where, that's the first thing. And then I would say the second thing is, really understanding that, right now, is not really the time to be working with folks who don't have a track record. And so when we think about the partnerships that we form and the people that we're working with, we really want to see that they have, some kind of experience or some kind of track record, and or that they're working with some kind of a mentor or a coach who's kind of directly overseeing the investment, so that we know that they are going to be able to perform well. And so that's always another question I get is, what's the biggest risk in the deals that we're doing? And I would say that the biggest risk is the ability for the operating partner or the asset managing partner to be able to execute on the investment, right? So anyone can put anything in an investment summary and say they're going to, they have these grand plans to do XYZ, but at the end of the day, the question is how good are they at being able to manage the whole process, which, as we know, when you have a 300 unit apartment building and you're renovating, half or all of those units, that's a pretty big project, right? So, so that's kind of like where it starts is all of that, and then I would say then it goes down to, okay, what market are we investing in, right? So those are other, that's another hedge is, I don't think, and this is my personal opinion, but I don't think that it's a good time right now to be investing in a market that doesn't have, either evidence of during the last downturn, some kind of, stability in terms of population growth or stable population. So in other words, not declining. And, so we're investing in, we invest primarily in the Dallas market. And so we invest there because of all of the job growth that they've seen, right? So, investing in those kinds of markets that have a lot of job growth and a lot of population growth, again, is another hedge, right? Because that basically is an opportunity for us to have these rental properties or these apartment communities, in areas where hopefully we won't see a big dip in occupancy. So that's another thing. There's a lot more. I'll turn it back over to you and see if you have anything to comment on that or add to that.
Yeah, and I think those are definitely great, like the starting points, right? The type of asset, and then the operator, and then the market. Those are definitely high level, the first things that we look at. And then when we get into the specific deal itself, there's a few additional levers, I should say, that we put into place. Things like, long-term financing, right? So nobody knows when the next recession will hit. And it could be tomorrow, it could be next year, it could be 5 years from now. We don't know. None of us know. But the only thing we can do is hedge against that. So with long-term financing, let's say we are planning to hold a project for 5 years. Well, ideally, what we'd like is to have a loan in place for at least that 5 years, if not 7 or 10 years. And what that does is, if there's a downturn at that 5-year mark, then, well, we don't have to sell right at that moment to pay back that loan. We have some additional buffer to then hold that asset a little bit longer. Which brings me to my next point is we only buy assets that cash flow from day one. So we're not buying assets where we're losing money and we're betting on appreciation. So if that were to happen, if the market were to soften at any point, we could just pause on any renovations and we could just, hold on to the asset and still be cash flowing. So that is an important thing as well. And then one more thing, actually a couple more things, but one more thing I wanted to add in there was about the CapEx budget or the renovation budget. And this is something that especially new investors should watch for as they're looking at different operators and how they do things, is you want to be sure to find operators that are going to be raising money for that CapEx budget up front. So those capital expenditures, those renovations that they're planning on doing, make sure that that money is being raised up front. There are people out there who will plan to pay for those renovations from monthly cash flows, and as you can imagine, that always can get a little bit dicey because what happens if one month you have great cash flow and the next month you're in the red, and then these renovations are sort of in flux. So that's another thing that we do is we always raise money for.
Yeah. And, one other thing that I would say, when you're thinking about as a passive investor, looking at getting into deals and you're, afraid of the correction or the recession, it really, and again, this is my personal opinion, but I don't believe that this is a good time to be getting into deals where, going back to the cash flow from day one, if you're getting into a deal that doesn't have enough cash flow to be able to pay out the investors, day one, then it pretty much what that means is that the investment really needs the money from the property to be able to sustain itself in these early, months or 6 to 12 months. So, I would say that be cautious if someone approaches you with an investment opportunity and they tell you that they won't be able to pay you for 12 months or more, because what that means is that there's not enough cash flow from the property to be able to pay you because they need that money to be able to, sustain the management of the property. And so, what happens if we hit some kind of a recession or correction 6 months, down the road? And they said, oh, the original plan was to start paying you 6 months after that, but we hit a recession. Oh no, all of the numbers have now gone out the window.
Mhm.
I would say another thing is, digging into the underwriting. When you're presented an investment opportunity, dig into the underwriting. I mean, that's, obviously what we do. And when you look at a deal, if you have an operator, who is underwriting, year one, I understand if you've got, year one, rental increases, particularly for the asset class and the strategy that we do with the value add. If it's like 5 to 7% year one increase, but if you've got subsequent years after that where they're showing a 5 to 7% year over year rental increase, I have a hard time believing that that's going to happen over the next 5 years, right? Because there's there's just, we all know we're not, at the bottom, and are we at the top? Who knows? And if those rental increases do happen, then that's great. But you never want to see that underwritten into the deal, right? Because basically when they underwrite it into the deal that way, it basically means that those rental premiums need to happen in order for you, the passive investor, to be able to achieve those, 18 to 20% annual returns, right? And so, that same thing goes for any refinances. I was just talking with an investor yesterday about this, and we were chatting about, best case scenario is that you go through a refi, you take that money, you reinvest into a new deal, and you're earning a lot of money, 16 to 20% cash on cash returns for doing nothing. And I said, yes, that's great, but you have to be very cautious and make sure that refinance is not underwritten into the deal, because again, if it is, then basically that means that refinance needs to happen in order for you to achieve those 20% annual returns potentially, right? So hedging, how do we hedge against a potential recession and downturn? I would say in a nutshell, it really comes down to being very conservative in your underwriting and making sure that you're investing in markets that have a lot of growth, and knowing who you're working with and making sure that they are, good people who, at the end of the day, if an investment goes south and you're working with really good people, there's a good chance, that those people will do whatever they need to do, to make investors whole before they take for themselves, right? So, knowing who you are working with, I think, is such a big piece of the pie. And I think so many people get so caught up in, deal specifics. And as we emphasize, really understanding who you're working with and knowing what their, philosophy is in operating these apartments, So, yeah.
Mhm. So at the end of the day, you're going to be they're going to be the shepherds of your money. So you want to really trust them and know that they're going to do the right thing.
That's right. Yeah. I mean, when I
So
first, oh, go ahead.
go ahead.
No, I was just going to say really quick that, when I first got into this, I probably spent a good 6 to 8 months, just vetting operators and talking with sponsors to really get a feel for who really wanted to take the time to get to know me and understand who I was and what my investment goals were, even if I only had $50,000 to invest. And,
Right.
obviously there are a lot of semi bad actors out there who don't really care about you, and all they care about is your money. And so they throw you an investment summary and ask you if you want to invest a week later. And so, that's one thing that I would say be wary of as well. If, someone doesn't take the time to get to know you and really let you know that you are important to them and they want to understand your investment goals and all of that. If you end up on a mailing list and, and then you get sent a deal, like, I would just say be very wary because, that's, particularly at this point in the market cycle,
Mm-hmm.
Yeah. So.
Yeah, well, I think we've covered a lot in this session, and I've folded a lot of laundry in this time, so I'm feeling pretty good. I'm getting better at this whole folding and talking thing. So
it's hard.
Practice, right? I know.
Yeah, it's like surprisingly not easy. I keep wanting to stop and talk, and I'm like, no. Got to do two things at one time here, lady.
That's
Come on,
right.
focus.
That's right. Well, if anybody listening, thank you for joining, first of all. And I know we talked about a lot during this folding session. But if you're new to passive investing, be sure to go to our website, goodegginvestments.com, and sign up for our free email course. And you will get all the highlights about what passive investing really is, and a lot more about all the things that we talked about here today. Okay, so that's it for us for today. We'll be back next week with a fresh load of laundry and another great riveting talk about real estate. So thanks so much for joining us, and we'll see you next week.
Bye, everyone.
Bye.